Over 90% of investors tend to underperform the market. This includes both regular investors, even hedge fund managers. This is because the strategies are often too complicated. Today, I wanted to provide a simple three fund portfolio that I believe all beginners and investors who aren't super into stock picks should stick to that tends to outperform the markets over the past 10 years. Before I show the backtesting results over the past 10 years, I want to talk a little bit more about the funds that are in this strategy and why I chose them that way. First one, the holy grail of all S&P 500 ETFs is VOO. This is essentially Vanguard's S&P 500, which is investing in the top 500 companies in the US. The sweet thing about any of these ETFs is that once you invest this money in the ETF, you don't have to do any of the stock picking, taking companies out, putting companies in. Instead, since this is managed, this is automatically done by the S&P 500 inclusions and removals of companies, right? Statistically, over any 20-year period, there's never been negative returns in the market in the S&P 500. So this is one of the best ETFs you can use as a foundation to build the rest of your portfolio. Next up on here, we have a slightly more tech-focused ETF being VGT. It's another Vanguard ETF that focuses on information and technology sectors. This is going to be big companies such as Google, Amazon, Meta. The Mag 7 is going to be slightly more weighted in those and other up and coming technology companies. I like this because, given that we're going to be in a really big boom of technology over the next 10, 20 years, driven by I think it's important to have diversification into the sector as it will often outperform the market and have really good years, especially when we're in uptrends. Finally, to kind of offset this risk from technology, we have VYM. It's the Vanguard Dividend ETF, similar to SCHD. This has more value-based companies that are slightly more defensive. So when the markets are performing poorly, when we're having pullbacks, they're not going to be doing as negatively, and you're still getting dividends. So that kind of helps soften the total return and make it a little bit better for those negative years. Overall, these three work together to kind of balance it out so that either way you're performing on par with the S&P 500 overall being the benchmark, or you're outperforming it a little bit even on down years and even more on up years thanks to the tech holdings. So getting into it here, we have portfolio visualizer. One thing I do want to preface before we kind of go into this and look at all the numbers, just because this outperformed the S&P 500 over the past 10 years, even 20 years, whatever time frame I may use to make this video get more views, that doesn't mean that it's necessarily going to outperform going forward consistently. However, I really do have faith that this is a well-balanced portfolio that's going to return at least market returns going forward due to its weighting and the way it's allocated. So here we can see the allocation that's in here. Again, I mentioned it's VOO, VGT, and VYM, and we're comparing it just to 100% VOO as the benchmark, right? We always like to use the S&P 500 as a benchmark so we can see how the general market is moving. Once we click Analyze Portfolios here, we're going to have some things come in. We can see that over the last 10 or so years, from January 27th to January 2026, this portfolio, based on a 50% split in VOO, 30% split in VGT, and 20% in VYM, is generating about a 17.1% portfolio return, right? These are absolutely amazing returns. And we can even see that over this time period, you would have gotten a return of 300%. You would have tripled your money. That's phenomenal, right? Scrolling down a little bit here, we can see portfolio number 2, which is VOO. This is again 100% VOO. We can see that the portfolio returns 15.1% over here. This is again 2% less than what we're getting on this three fund portfolio. But, let's see how it comes head to head every single year, right? That's what's the most interesting part of this, right? Here, one thing I do want to point out is the worst year and best years. You can see best year about 35% for the three fund portfolio versus 31% for the market. But I do want to point out that the three fund portfolio had a higher maximum drawdown overall. But if we look over it year to year, we can see the gap slowly widens. If you're starting with $10,000 in both of these, by the end of this experiment, this back test, you could see that the three fund portfolio, you end up with about $42,000, and with just the VOO, you end up with about $36,000. Again, this is only over a 10-year period. That 2% makes a huge difference over a longer period of time compounding, right? Over here, it's only $6,000, $7,000 roughly. Over a 20, 30, 40-year-old period, that 2% could be hundreds of thousands of dollars in difference, right? And here we can see the precise breakdown year by year. Even in the worst year right here being 2022, we can see that the portfolio performed slightly better than the market. The only year that I'm seeing that it got outperformed by the market was 2021. But overall, we can see that the portfolio one, being this dark blue one, is outperforming almost every single year uh, so far. And that's kind of what this is about. I really want to simplify investing for people. I've been reading a book called A Random Walk Down Wall Street, and it says how people try to do too much with their money. They try to trade in, buy into a position, sell out of a position, when the best way to perform in the stock market is just to buy and hold assets long term. So if I was a beginner investor, if I had to set up a portfolio for one of my family members, this is the portfolio that I would set them up on, because I know that it will perform as good as the market at least, and it has some hedging regardless of what happens in the market, right? So I feel super confident recommending this. Again, I'm not a financial advisor by no means. This is just a portfolio that I would do if I was a beginner who was not interested in stock picks, or it's a portfolio that I would recommend to my family members based on kind of what I've learned, what I've read about. One thing I will say that's probably a little bit biased, because I'm a younger investor. Most people, when they do a three fund split like this, they'll put the technology portion at 25% and the value dividend portion at 25% as well. But in my circumstance, I'm a little bit younger. I have time for this slightly more aggressive technology holding to pay off. I think, you need to have at least 10, 15, 20 years for it to be worth it. But this allocation would look very differently if I was approaching retirement. I'd probably be throwing in some bonds and other stuff in here to kind of even this out. I also do want to be transparent. This isn't an allocation that I use in my portfolio currently, because I guess I'm a gambling man. I enjoy doing research on stocks and making decisions based on that on stocks that I think will outperform the market. So far, I've done pretty well. There's no guarantee that that will hold, but I think the most important concept of investing is to buy and hold your assets, right? You don't really want to be buying, then waiting for a time where you think it's good, selling, then buying again and selling, because not only on this are you cutting your winners short, you're also taking on realized profits, which you have to pay taxes on, which ultimately takes away from your total return. The best thing you can do for your future wealth building is to start these investing habits nice and early, dollar cost average into the markets, buy consistently, set up the systems, and let them work for you for years on to come. Eventually, you'll forget about it. You won't have to worry about how much you're investing, when you're investing. Once you automate all this, your wealth building will happen automatically. You won't even have to do anything about it. And then 20, 30, 40 years down the line, you're going to look back and be so grateful that you started this journey of investing and made it as simple as possible, so you never have to worry or fret about it. Let me know if there's any other ETFs you think I should have included in this. As always, if you enjoyed this video, feel free to like and subscribe, and I'll see you guys next time. Take care. Bye bye.